Markets rarely move in straight lines, but every now and then you get a cluster of events that quietly rewrites the next 12 to 24 months. This is turning into that kind of week. Less about fireworks, more about how the chessboard is being reset. I'm Mark Roach, and this is FutureWise Energy, an independent upstream energy platform supported by individuals who care about signal, not noise. What you hear here on this platform comes from 3 decades of operating oil and gas fields, cutting deals, watching how policy, capital, and geology collide. Let's start on the tape. WTI is trading in the high $57 range today, essentially flat to slightly softer than Tuesday's close after briefly testing down near $57.10 when the Ukraine peace headlines first hit. Brent is holding in the low 60s after a 1-month low close, with only modest intraday bounce as traders absorb the idea that Kiev has largely accepted the U.S. framework. The story underneath those prices is simple. The market is trying to price a world where sanctions on Russian exports might ease into an already heavy 2026 supply picture. But no one knows if or when Moscow actually signs on. That keeps crude sentiments stuck, like in a narrow band. Not panic, not euphoria, just a defensive stance around month lows. On Ukraine, the mood has moved fast. A day ago, the reaction was shock that Ukraine had substantially agreed to a U.S. designated peace plan built around 28-point framework that with deep economic and energy linkages. Today, the language has shifted to wait and see. Oil is described as stabilizing near the lows while the market watches for any concrete response from Moscow and any hint of what sanctions relief would actually look like in practice. Sanctions on Rosneft and Lukoil remain the sharpest tool in the box, and they're still cutting. Russian fuel exports are sitting at wartime lows when disproportionate share parked in floating storage, and buyers in India and China are being forced to navigate insurance, payment, and compliance landmines that didn't exist a year ago. If a peace deal sticks, the question isn't just, do sanctions lift? It's on what timetable for which products under what monitoring regime. The answers to that will decide whether we see a controlled re-entry of Russian barrels or a messy flush that drives another leg down in prices before the market can balance out. Now zoom out to OPEC+. Nothing new has dropped ahead of the November 30 meeting, but expectations are unusually aligned. The base case is a modest 137,000 barrel per day increase in December, followed by a pause on any further hikes through 2026 as the group tries to manage a projected multi-million barrel per day surplus. That leaves OPEC Plus walking a tightrope. Defend price too aggressively, and you hand share to U.S. shale and to Latin America. Chase share too hard, and you lock in sub $60 Brent in a world where demand risk is still skewed to the downside. For upstream investors, that tension is more important than the headline quota number because it tells you how much volatility that you should budget into your long-dated cash flows. On the corporate side, the Citco outcome has snapped into a much clearer focus. A U.S. District Court has now formally adopted the Special Master's recommendation to award PDV Holding, the parent of Citco, to Elliott's Amber Energy Group, even though a rival bid from Gold Reserve came in roughly $2 billion higher. That decision is being treated as a live case study in how U.S. courts weigh creditor recovery, sanction architecture, and foreign policy into the energy space. Gold Reserve is not going quietly. The company has stated that closing is staying at least 7 days after OFAC issues a license and other regulatory approvals land, and it has flagged the possibility of appeals or additional challenges. So on paper, Amber is the winner, but the execution clock is now tied more to Washington's licensing calendar than to Delaware's courtroom. Exactly the sort of timetable mismatch that trips up impatient capital. In U.S. upstream, the diversified energy canvas transactions that has quietly crossed an important threshold. The operational story is unchanged. Central Oklahoma production and inventory bolted onto a portfolio that lives off mature gas-weighted assets, but the equity mechanics have now caught up. New shares issued to former Canvas holders are expected to be trading on both the New York Stock Exchange and the LSE as of November 25th, which matters for liquidity screens and for anyone trying to model float and index exclusion or inclusion. In U.S. upstream, the diversified energy canvas transaction has quietly crossed an important threshold. The operational story is unchanged. Central Oklahoma production and inventory bolted into a portfolio that lives off mature gas-weighted assets, but the equity mechanics now have caught up. New shares issued to former Canvas holders are expected to be trading on both the NYSE and LSE as of November 25, which matters for liquidity screens and for anyone trying to model float and index inclusion. South of the equator, the numbers out on Argentina's Vaca Muerta still tell one story. Scale is here, not hypothetical. Unconventional oil volumes of the play are running in the 550 to 590,000 barrel per day range as of September, roughly 30% higher than a year ago, now well over half of Argentina's total oil production. Recent coverage has focused less on new records and more on maps, type curves, and deal chatter that treat Vaca Muerta as a core supply source alongside Brazil and Guyana in the next non-OPEC growth wave. From an investor's standpoint, here's how to read all of this together. First, the Ukraine framework and Russian sanctions are no longer abstract risk. They're now the main driver of why crude is stuck near lows instead of snapping back. Second, OPEC Plus is signaling that it sees the same potential to 2026 glut that most of you do, and it's already dragging its feet on adding more barrels even before the peace process is resolved. Third, the Citco decision and the way it's being executed show that in politically encumbered assets, the spread you earn is compensation for legal and regulatory latency, not just commodity beta. The fourth, Latin America supply build-out, Vaca Muerta in particular, means that even if Russian flows remain constrained, there is credible path to non-OPEC growth that keeps a lid on prices deeper into the decade. This is not a market where you get paid for predicting tomorrow's settlement price. It is a market where you get paid for understanding how peace terms, sanctions, courtrooms, and shale learning curves stack on top of one another. Position yourself for a world where barrels are not scarce, but clarity is. I'm Mark Roach, and this is FutureWise Energy. Keep your wits about you, your eyes wide open, and be very deliberate about which part of this value chain you choose to own.